뉴욕나우. 안녕하세요. 한국경제신문 뉴욕 특파원 강영연입니다. 글로벌 시장에서 통하는 투자법을 알려드리는 뉴욕나우. 오늘은 리처드번스타인 어드바이저스의 마이클 콘토포울로스 채권부문 임원에게 내년 미국 시장 전망과 유망한 투자 분야에 대해 이야기 들어보겠습니다. 마이클은 크레딧스위스, 뱅크 오브 아메리카 등에서 채권 전략을 담당한 채권 전문가입니다. CNBC, 블룸버그 등에서 정말 자주 찾는 전문가 중 하나인데요. 한국 언론과의 인터뷰는 이번이 처음이라고 합니다. 오늘 인터뷰에서는 최근 시장에 관심을 받고 있는 주요 이슈에 대해서 물어보려고 합니다. 먼저 오미크론으로 코로나 재확산의 우려가 커지고 있는데요. 이는 시장에 어떤 영향을 미칠까요? 제롬 파월 페드 의장은 테이퍼링 속도를 높이겠다고 했는데 그간 인플레이션이 일시적이라고 주장하던 의장이 갑자기 매파로 돌변한 이유는 무엇일까요? 올해 시장은 인플레이션, 코로나, 중국 등의 영향을 많이 받았는데 내년 시장에서 가장 조심해야 할 위험 요소는 무엇일까요? 또 이런 불확실한 시장에서 투자자들이 관심을 가질 분야는 어디인지까지 한번 알아보겠습니다.
I think this was a little bit unexpected that it would have come today. I think, a lot of investors were anticipating that the Fed might, discuss speeding up the pace of tapering in the December meeting. But I think that it came today is a little bit earlier than what the market had anticipated. So it's a bit of a surprise, particularly with everything that's going on with this new coronavirus variant and the fact that, Chair Powell were to disclose this potential faster tapering and a day where you already had risk off is maybe not the ideal situation or what the market expected. But certainly the idea of a faster taper makes a lot of sense given what we've seen with inflation over the last 6-12 months. So we've been saying at RBA for roughly the last year that inflation is likely to surprise to the upside and last longer than most expect. And I think today was just an acknowledgement by the Fed that, that we're right in that assessment that, there are both secular as well as cyclical forces for why inflation likely remains elevated. They're not going to go away, in 1 month or in 2 months' time, and that they're likely to be here for some time. What's interesting to me is that the idea behind the Fed's transient view is that, there's a reason why inflation should go down. And that makes it transient. So the Fed prior to today said, okay, supply chain bottlenecks are likely to relieve themselves as people come back to work. And when when people come back to work and the supply chain constraints are relieved, then inflation should come down. And so when the Fed thinks about transient versus permanent, that's the way that they think about it. What they're telling us is that even as employment accelerates, they find that there are structural reasons why inflation may not fall as much as they expected. That's a big shift for the Fed. I think it's really something that investors need to pay attention to. So I think there are 3 main structural reasons why inflation likely continues to surprise to the upside and last longer than most expect. And by the way, this doesn't mean that we think inflation is going to stay at 6% forever. It will come down. It will just be higher than average than what we've seen over the last 20 years. Those 3 reasons are, first, globalization. Globalization helped to depress inflation over the last 20 years. Globalization has peaked, and now we have some degree of deglobalization. And so I think that is one reason why, in a structural way, the inflationary dynamic is likely to be higher than most expect, particularly as companies will no longer want to rely on a global supply chain going forward because of everything that we've seen with the coronavirus and bring much of that manufacturing back to their home country. That's deglobalization. Again, that is inflationary. The second factor is, remember, everybody has always said an aging global population is disinflationary. And the reason for that, imagine you have an aging demographic that saves for retirement. As they save for retirement, you see inflation in financial assets, but not in real assets, because all of that money, all of those savings are going towards financial assets, not into the real economy. But once that aging population retires, then they draw down their savings and they spend it. And the spending of savings is inflationary, not disinflationary. So that's the second secular force that should drive inflation modestly higher relative to the last 20 years. And the third factor, which I think is the most likely factor that the Fed recognized today, is what you're likely to see is wages start to increase. And so as wages increase, the power shift from the employer to the employee. And I think that's what we're seeing in the United States. We see, unions starting to have more power. Mobility of labor has given employees more power. Minimum wage is starting to go up throughout the country. And so I think in order to entice people to come back and relieve many of the bottlenecks that we have today, you're going to have to pay employees more. And all the signs suggest that that's the direction in which we're headed. I think certainly short term, it's going to have a somewhat negative impact on market. But what really matters over the medium to longer term is what are profits doing with respect to the equity market? What's liquidity look like? And what does sentiment and valuation look like? And the profit cycle, looks still strong. As we look out to Q1 and Q2 of next year, profits should be continuing to have strong growth on a year-over-year basis. Liquidity is certainly going to tighten as the Fed tapers their asset purchases, but there's still tremendous liquidity globally from central banks. And that should be somewhat supportive as well as we go into the first half of 2022. Sentiment and valuation, it depends on where you look in the market. Some areas of the market have extreme sentiments and valuation measures. Other areas of the market have really been overlooked by investors over the last 24 months, and we think still provide opportunities. So, I think much of what we're seeing today, what we're seeing from last Friday, is likely near-term knee-jerk reaction from markets. I think over the medium to longer term, it's really going to come down to fundamentals and what are profits doing. And that's going to be the most important measure. And profits still look pretty healthy for Q1 and Q2 2022. Rate hikes, yes, are generally bad for any long duration asset, whether that be treasuries or whether it be growth equities or speculative technology. They're all long duration assets at the end of the day. And so we do think it's going to be a difficult environment for traditional fixed income. Not all fixed income, though, necessarily has a big duration component. You can invest in credit risk, for example, which takes the difference between interest rate risk and the overall bond yield, and that's your credit risk. And that actually looks pretty good to us. So I think it depends on where in the bond market you're looking and how do you express your view in the bond market. If you're going to take duration risk, which is interest rate sensitive, then it's going to be a difficult time as the Fed raises rates and interest rates go higher next year. If you look more at credit risk, particularly investment grade credit risk, we do think there's opportunities there. Yeah, I think the middle of summer is a good timeline to expect the first rate hike. It's very difficult to forecast. A lot can happen, of course, between now and then, both with coronavirus as well as how much tightening is basically achieved through tapering asset purchases, because that's really what the reduction in asset purchases is. It's a tightening of financial conditions. So I think what the Fed will want to do is they're going to want to see how all of that plays out. What happens from a pandemic perspective, but also what happens from the tapering of their bond purchases. And so I think it's a reasonable timeline to expect sometime between June and September of next year to see the first rate hike. After that, I think, you could get another one later in the year, perhaps September or December, depending on how early they start. I would be surprised at this point to see more than 2 hikes in 2022, but it certainly isn't out of the question that we could see anywhere from 1 to 3. That's right. I think that should be a core base case scenario. Well, if they hike twice, that would put you at a benchmark rate of about 75 basis points for the federal funds rate. So that seems somewhat reasonable to us. And I think the 10-year Treasury yield, you could see anywhere from 2 to 2.5%. And so quite a bit higher from today. That's typically how it works. If the Fed is hiking rates and inflation is strong and growth remains stable, if not getting better, and they're reducing the size of their balance sheet relative to GDP, you would expect a much higher 10-year yield than today. And that's pretty much what we expect going into 2022. Well, we certainly think that at the broad market level, you could have margin compression in some areas of the equity market, but there are others of the equity market that will do quite well in an inflationary environment. Financials, energy, industrials, those will all do very, very well as inflation goes up. Think about why inflation is going up. In large part, it's going up because of higher energy prices. That bodes well for energy stocks. Financials do well when you have a higher rate environment, particularly if that higher rate environment is accompanied with a steeper yield curve. And so although some of the areas of the market may be influenced by higher inflation and lower margins, there are some areas of the market that'll actually do well in that environment. We're also seeing, incidentally, that many of the consumer brands out there are able to pass along some costs. And so they're able to pass through the inflation to consumers. So much of the margin compression and inflation story and how that affects corporate profits is going to be determined by the ability for many of these companies to pass on those costs to their consumers. So I think it's too early to say how much of an impact inflation will have on those types of areas of the market. But we do know that areas like energy and financial should continue to do well, even in an inflationary environment. Well, so this is an area that we're very concerned about. You look at technology, and technology is effectively a long duration asset. We talked about that earlier, very sensitive to interest rates. The reason why is because many of these tech companies are being priced, their valuation today is a function of future earnings, not earnings made today, but rather future earnings over the next 1, 3, 5, or 10 years. If inflation is going up and interest rates are rising, the value of those future earnings are worth less in today's dollars. And so as interest rates rise and inflation goes up, we think that much of the technology portion of the market is likely to suffer, right? It's going to suffer as rates go higher and inflation increases. This is also the area of the market that's realized the most inflows and has the most hefty valuations. And profits, by the way, are very middle of the pack for technology as we look out towards 2022. So they're not even at the top of sector returns in our forecast for next year. And so when you couple all of this together, we think technology could have a very, very difficult year next year as many of those trades start to unwind. Well, so I think we have to separate broad market from internals. You could have a situation where you have two different markets playing out. If you have inflation continuing to go up and yields rise, but you have a strong growth environment, that will do, you might see the broad market decline, but value really outperform growth in that scenario. And so there's nuances to what the risks really are. We don't really focus too much on the broad market, but rather on what's going on with the internals of the market, the sector level, the regional level, the size and style. And so each one of the risk factors you mentioned are going to impact areas of the market negatively, but could also impact other areas of the market in a more positive way. We're probably most concerned about is a major slowdown in corporate profits, right? As we look towards the back half of 2022, Q4 2022, going into 2023. That to us is the biggest risk that really not many people are talking about at the moment. You have the risks around inflation, but then again, you could do very well in financials or energy. So I don't know how much of a risk that really is. You have risks around higher yields, certainly for technology, but that should be good for value and not good for growth. But an earnings recession, if earnings were to come down significantly, we think that's an area that is concerning for almost every area of the market. It's certainly something that is not on very many people's radar at the moment. Well, we think if you look to any of the past variants that we've seen over the last year and a half or so, the market's been able to look through them. I think it's too soon to say whether or not Omicron is going to be a similar type variant, and whether or not vaccines and the the medical community are going to be able to keep up with the new variant. And so it's certainly something that we need to keep an eye on and we need to monitor. But are we going to change our investment strategy today because of what we know right now? The answer is no. But it's certainly something that we're going to continue to watch and continue to see if there's an effect on corporate profits and an effect on liquidity and sentiment valuation. So I think for right now, as we look out towards, certainly the first half of 2022, there's a bit more uncertainty in the markets than there has been over the last year or so. And so we think investors need to start to hedge their portfolios a little bit more, but can take comfort in the fact that the profit cycle is still quite healthy and value should continue to do well. Again, I mentioned energy, I mentioned financials as areas, as well as U.S. corporate credit risk. I think all of those areas will continue to perform well as we turn the page on 2021 and into 2022. Probably the biggest area of concern for us are these long duration assets that won't do well as inflation and rates go up, primarily tech and growth. And so that's the area of the market that we think could generate the biggest headlines next year from an underperformance perspective as rates and inflation accelerate. I think the dollar's future is fine. It's intact. The question is at what level do we see it over the next 12 months? I think it's a very difficult question to answer. It's obviously strengthened for a bit of time here. Our bias would be to a bit weaker from this point. But we do think the dollar probably is somewhat range bound. You have competing forces on why the dollar should go higher versus going lower. And those are going to continue to be at odds next year. And so, we don't see any reason for an extreme richening of the dollar nor cheapening of the dollar. Imagine that it'll be trading, within a tight range that it has been for the last couple of years. Certainly. So listen, at RBA, we use ETFs to employ our strategy. ETFs allow us to look on a macro basis. If you look over time, what matters to returns tend to be macro factors, not individual companies. And so if you get the right region, the right sector, the right style correct, then you're going to capture the bulk of returns, both within fixed income as well as equities. And so leveraging ETFs to express macro views makes a ton of sense for our firm. They're also relatively low cost and very, very liquid, so it allows us to be tactical. And so the best way, in our view, to invest in the US markets and the way that we do it at RBA is to leverage ETFs and our expertise around selecting those ETFs.